We have such a great episode. I just had a great time.
I had a really great time too. We had Maya Bakhai on. She is the founder of Spice Capital. There may be some other title that happens when you have your own venture fund, Solo GP of Spice Capital, which is a venture fund. And everything you wanted to know about how the venture business works, but we're too afraid to ask, we got you covered.
We got you covered. And she also left no prisoners. She really said it as it is.
She did. She shot it straight.
I loved it. I was like, man, I don't know that I would have the I don't even want to say this, the balls.
Yeah.
I don't know. What's another way of saying it? Like, I've never said that before. I don't know why. The gumption.
There you go.
The gumption to just shoot it straight like that.
Everyone was catching strays.
Left and right. Crazy. But it was great and learned a lot. Like, I feel like I have a good understanding of venture businesses. And then after listening to her, I was like, whoa, I have a whole new layer to this. And also her just thesis and perspective. I just really like her. She's a great person. She's also a friend. And so I feel I must disclose that. Anyway, it's a great episode. You'll learn a lot about venture capital. You'll learn a lot about Spice Capital. And I hope you enjoy it. The Feelings Check-In is a podcast for people who love to listen to two women overshare about the challenges of building a business, navigating careers in tech, and trying to have a personal life. I'm Natasha Hoskins.
I'm Deana Burke.
And this is Boys Club.
Wait, is it just Boys Club?
It's just Boys Club.
The Boys Club podcast?
No. Just Boys Club.
On today's show, we have Maya Bakhai, who is the founder and sole general partner at Spice Capital, an early stage fund investing across themes of blockchain, applied AI, and the creator economy. Maya, welcome to the show.
Hi, thank you for having me. I'm excited to be here.
Maya, so excited to have you. Okay, I want to start with a softball. Can you give a 101 on venture businesses, how they work, how someone like you gets paid as the person who's running it and going for it, and then sort of like what the models are for venture capital businesses?
Yes, happy to. Okay, so let's see. I think a lot of people don't know, even I didn't know when I was younger, that VCs are actually, it's a firm, it's not their money. So in 99% of the cases, when you meet someone who's a VC, it's not like they're independently. I mean, they can be independently wealthy, but it's not like it's all of their money that they're going and then putting it into startups. It's usually, if it's their own fund, it's a fraction of their money. So they're not really all in the way the founders are, or they're managing money on behalf of a group of individuals. That could be individuals like all of us, could be investors in a fund like Spice Capital. It could be endowments. So it could be like Harvard, if you want. It could be nonprofits, like the church actually invests in VC funds. I just learned that.
Oh, wow.
Random. Yeah, we love that.
We love that.
Or it could be other funds that want access to deal flow. So really, it's a financial service. So as far, a lot of times in venture, people act like the VC is just like a founder, but really it is a finance function. They are managing money and they have a fiduciary to outside investors. The firm is a group of a bunch of investors. They call it the LP. And the way they make money is, well, usually they'll, say, okay, I'm going to raise a bunch of money. They'll go pitch everyone. They'll pitch Harvard Endowment and say, look, I'm going to go deploy this. I'm the VC firm into a bunch of startups. And here's our strategy. Here's our edge. We're only going to do this stage of investing, and we got you covered on all pre-seed, or we got you covered on all fintech or all crypto. And they say that to their investors, they collect the money, and then the way they get paid is twofold. So on the one side, and it's called colloquially, it's called 2 and 20. That's the word. And the 2 stands for 2% management fee, and the 20 stands for 20% carried interest. We're going deep now, but I feel like it's
I love it. It's great.
No one talks about it, and it's like so interesting. So the 2% is where it gets a little grifty. And so you get 2% every single year as a management fee to cover your overhead. So let's say you had $1 billion fund from some of the names we read about. They're getting paid $200 million over the course of 10 years. So 20% of the total fund size for overhead. So that includes partners' salaries, associate salaries, travel. I mean, that's why you see so many events. That's why you see them like launching full media businesses within their firm. It's like, where is this coming from? It's from that management fee. Everything is drawn from there. And so the 2% is actually, and this is something I did not know, really comes down to 20%. So whenever you hear in the news like XYZ VC firm raised a $5 billion fund, you should know in your head that 20% of that is getting pocketed regardless of the outcomes. They could invest in all trash, but they're still going to get that money. And so
let me just ask a clarifying question, because so it's the two actually is 2 per year and a 10-year fund, which is how it reaches 20% total.
Yeah. So a lot of times you hear 2 and 20 and you think, okay, they're getting paid 2% and then 20% of carried interest, which means the profit. So after the money's returned, 20% of all profits come back to the firm that raised the money. But yeah, the reality is it's 2% annualized over 10 years. So it's actually 20%. And so for every dollar that's put into a venture capital firm, in the beginning, only 80% of it is really invested. The other 20 is put aside. And so that's important, I think, because that really tells you right there, if you follow the money, it tells you what the real incentives are of 99% of VCs, really 99%. It is collecting that AUM because let's say, I mean, if you think about it just objectively, if I'm joining a company or joining a VC firm and this is my job or livelihood, I'm not an owner, I'm incentivized to raise as big of a fund as possible because that's guaranteed. 20% of that is guaranteed to come into the pocket, right? So your incentive as a VC firm is to gather as much AUM as possible. It's actually, you have less of an incentive to be returns driven.
Wow.
Ironically. And that's something that the bigger you are with scale, that's what ends up happening. You become an asset manager.
And then that second 20% is...
Yeah, so the second 20%, is called carried interest. What that means is essentially you get paid 20% of the profits. So if the fund, let's say the fund is $100 million, or we'll make it easier. Let's say the fund is $1 million to make it the math easy. And they invest in 10 companies and one of the companies becomes Coinbase. And that $1 million fund all of a sudden is worth $100 million. So it 100x's the fund. The fund manager gets to keep 20% of the profits. So if from 1 million to 100 million of that, they take 99 million and they keep 20% of 99 million of all profits. So it's pretty cool.
It's very cool. Very cool. When it's a Coinbase, it's very cool.
Very cool when it works.
And so let's talk a little bit about like the time horizon and scale of that. So my understanding of maybe venture capital 10 years ago, or even maybe a little bit longer than that, was they were always sort of 10-year time horizons where you would raise a fund and then you would deploy that capital and the expectation would be that there would be a return on that capital over the course of 10 years. I feel like that has gotten exponentially faster over the past, let's call it 5 years, where it became faster and faster in the cycles of funds raising their next fund and the returns on the fund. And then there was like crazy IPOs. I'm curious where you feel like the timescales are today and if you agree with that hypothesis that it's sort of evolved over the past 10, 15 years.
Yeah. I think what's also interesting, didn't know this before starting my own fund, is the time horizon of the fund is over 10 years, which means if you collect money from an investor, let's say you guys are my investors, at year 10, you're expecting to have some sort of return, like wherever you are. So if it's gone to zero, you're expecting to start getting back some of that money. The time scale hasn't really...
Wait, sorry. If it's gone to zero, getting back that money, say more about that.
I mean, this is the craziest part. There's no real... The only downside there, I mean, obviously the investor's money goes to zero. So there's very much a risk it can go to zero. But me as the VC firm, I already got paid my management fee. What I won't get is 20% of the profits because there were no profits. But like, that's the part that's a little bit dicey where I'm saying, and grifty is I'm using that word is like, what if that it's such a long time horizon that no one actually knows if you're good at investing for 10 years. So like no one's coming to collect for a very long time. The only time they'll come to collect is if you need to raise another fund in the interim. And so going back, Natasha, to your question about the time scale. So when I started, so my fund was like peak ZERP is when I started my fund one. And at that time, the going consensus was raise a new VC firm every 2 to 3 years. So every 2 to 3 years, you raise a new fund. So not only do you just have all the different payment structures we talked about, you're stacking those payments. So if you have 3 funds running over the course of 6 years, and each one's $100 million, you're getting $20 million from each of those funds.
Wow.
And it's all under the same holdco. I know, must be nice. I'm not there, to be clear. I wouldn't be sharing all of this if I was there. I'd be on an island. And so the reason why is like, even when you pitch, what you're really saying is you spend the first 3 to 4 years of the fund actually investing. And so for us, like, we started in 2021, and for the first 3 years, we deployed into almost 50 different startups. And then the second half of the fund life, you're kind of just waiting for them to cook. So you're waiting for them to mature. You know, a bunch of them will fail. You're trying to help where you can. You're trying to put more capital in. Like, you're using your network to increase the enterprise value of that company to your best of ability. But you're really only deploying for the first couple of years. And so as a result, what people do is once they've deployed their fund and now it's just waiting, and sometimes it takes, 7, 8, 9, 10 years for a company to get to real scale that we read about in the news. While they're deploying, they'll go raise another fund and so there's always a continuous batch of new investments that they're making. So that's really the time horizon in the design.
What if, and this might be kind of tactical, but what if there's an event? Well, first of all, what are the events that a startup can have that would precipitate that 20% return? It would be an acquisition or an IPO.
In blockchain, like if there's a token launch, if somebody launches a token and that returns my fund. I mean, I've seen it with people that invested in Solana early. Like, there are many folks that had $20-30 million funds, and they put $1 million position in Solana, and that $1 million position was worth like $50 million.
Okay.
So essentially now they've returned their entire fund. So first you have to make, it depends on everyone's documents, but the standard documents, you can change it, are first you have to make your investors whole. So as soon as you clear out it's called return. When people say we want something to return the fund, what they mean is if your fund size is $20 million, you want one investment to be able to return the entire fund, to be worth the size of your fund at the time of exit. And at that point, everything from then on is profits. And you keep 20% of them.
Got it. So the time horizon in traditional venture investing in ZERP era, that 10 years is standard, but that gets compressed considerably with crypto potentially. Does that create any other weird like side effects?
So it doesn't necessarily, this might be too minute. The time horizons are still the same, but the time to exit is faster. So the fund legal structure will still exist for 10 years, but the investors that are participating in the funds maybe have an expectation that the cycles move a little bit faster. So they're expecting that if they're investing in a fund that has exposure to blockchain in years 3 to 4, we've seen this. We've all seen projects start and within 3 years launch a token, right? And so they're expecting in years 3 or 4, after the token vests, whatnot, to start earning some of their money back. So I think that's also why blockchain funds have been able to raise so much. Like, there's multiple $1 billion plus crypto funds specifically, even in a time when everyone was like, oh my God, tech is dead, or the stock market is crashing, crypto is still able to raise a lot. It's because the investors, when they look across everything they could allocate into, they're like, wait a second, if I put it into blockchain, I don't know what the fund manager is doing, but I'll get my money back in 3 years. Like, that's amazing. Versus 10, it becomes very lucrative. And so I think if you have an understanding of the blockchain market and you are in VC, I think you would be remiss not to participate, because it's like an earlier return. You also are incentivized to do that. Start earning part of the profits as soon as you can get the money back. Yeah. So I think that's why VC or crypto VC has been able to raise so much, and it looks so ridiculous, but it's really just like, we're just moving money around really quickly. It's easy. It's an easy sell.
That makes a ton of sense. Okay. I want to move to sort of the current sentiment around venture capital. So there's a lot of chatter recently about venture funds and venture funding. 2021, we saw really frothy market, big checks, huge valuations. And then over the course of the last few years, it feels like that has really sort of course corrected. Yeah. And I read recently in 2023, VC saw a 35 year-over-year decrease from an already declining investment year in 2022. There's sort of the sentiment that maybe venture capital is like imploding on itself as a business model. Where do you think we are today as someone who's running their own fund? And then also, where do you think we'll be in 5-10 years as funds are starting to need to return or show themselves?
Totally. So yeah, I think it's helpful that you asked the question earlier about how does VC work and what's a business model, because if you think about it, what started to happen was the cost of capital was really low. Number one, in zero interest rate, it's easy. It's like a cheaper environment. It's easy to get $1. You can borrow $1 for free effectively. And so cost of capital is very low, which means when cost of capital is low, if you can get free money and put it in the riskiest thing possible and essentially take your zero interest loan and turn it into new money, it's very tempting. And so everyone did that. Like everyone went risk on, as we know, like this is nothing new. It's been talked about so much. Okay, if I'm being honest, I think a lot of the issues are actually the VC's fault. And so they were incentivized to keep raising bigger and bigger funds because it was cheap, because nobody actually came to see their returns for multiple years. The stock market was ripping. And so people kept saying, oh my goodness, like every single company that was going public would have like crush their IPO. And so people kept trying to go earlier and earlier. They're like, let's invest in pre-IPO, let's invest in Series B, let's invest in Series A, let's invest in seed. So everyone wanted exposure to VC because they wanted to get in before things popped off. Because if you looked at the stock market, everything was up and to the right. So many people across the world were like trying to allocate as fast as possible into venture, into tech, because that was the only thing really taking off, right? Especially right after COVID. And so what ended up happening is you have these fund managers who all of a sudden are like, oh my God, I have so much investor interest. Like even me, when I was starting my fund one, some of the biggest institutional investors in the world, like $1 trillion asset managers, were coming to me to be like, can we invest in your fund? And I was saying no at that time because I'm like, this isn't aligned at all. I'm a very small fund. But everyone wanted to be as early as possible. And like, I'm sure you guys saw this in crypto. Yeah. Okay, so because of that, what ended up happening is so many people raised funds. Like there were too many funds raised. And there's really, if you think about it, if there's too many funds raised, what started happening was people would fund copycats of the same business. So it would be like Coinbase takes off. And then you see like 30 other Coinbase copycats. Like Coinbase is already the market leader, and then you would see 20 other Coinbase copycats being funded, or like Uniswap, for example. And there's so many like copycats of Uniswap, right? There was like Pancake Swap, this swap, whatever. And you see people just funding the same thing because it's a lazy way to deploy capital. It's what they tell their investors, and they have the capital. So if you're raising funds, like remember I told you earlier, you have to every 3-4 years like show you're deploying so you can raise another fund and collect more management fees. So what do you put it into? People were lazy and put it into copycats. And so as a result, you have like so many duplicate businesses that don't actually need to exist, but they were minted because the VCs wanted more management fee and needed something to invest into. And so then
I love these you're coming in hot on venture capitalists. I love it.
I mean, I remember too, right? It'd be like any person who was at Stanford or MIT who was smart, who had an interest in crypto, people would be like, oh, he's really smart, he'll build something. And they'd give that him. I'm saying him, it's usually a guy. You never see this for a woman.
Yeah.
I know a female founder who also went to MIT, and people would question her and be like, we don't think you're technical. And I was like, I can't. Classic. We won't even go there. But yeah, so what ends up happening is all these people were getting funded with that had no business idea. It was kind of the VC's fault because they wanted to say they were early too, and they wanted a chance at like the gold rush. And then you see what happens when there's a correction. And the way the correction really happened is it started in the public equity. So as soon as interest rates increased, cost of capital now goes up, and revenue multiples, like it used to be like 100 times revenue in private markets, and sometimes even in the public market. So if you look at the valuation of companies in the stock market, tech companies, let's say they're trading at 100 times revenue, all of a sudden over the course, like slowly of 3 to 4 months, you saw that compress. So now they're actually not trading at 100 times revenue. Now it's 80, now it's 50, now it's 30. And most VCs don't pay attention to public markets. So number one, a lot of this could have been avoided. A lot of the chaos and the pullback of funding and pullback of term sheets if the VCs actually looked at the news or looked at the stock market and weren't in their own bubble. So that was number one. Like it was almost like 8 or 9 months before you started seeing all the drama in tech Twitter that things were happening in the public market that you could look to. So that was step one of the unraveling. Step two is, okay, now if the IPO price is at a way lower valuation than we thought, in the public markets, you can't price the company the same way. Same thing started happening in crypto. There was a point where every single token launch would like at minimum go to $1 billion market cap. Like that's what everyone used to say, like, oh, it's just easy, get to $1 billion market cap and the valuations are higher. Now, all of a sudden, the market cap started shrinking to 100 million. So now if you're a VC and you have to deploy and the entry valuation, like your entry valuation can't be $100 million anymore. It needs to be lower because if you're IPOing effectively at $100 million and you're investing at $100 million, that's a flat investment. No one's making money. You like slowly see it trickle down first from public equities, then into late stage growth, then into kind of early stage and venture, which I would say is like a stage before. And then you see that trickle down all the way to the founders, where the net new founders coming up with actually new ideas got the brunt of it. That's we're trying to raise and have been trying to raise over the past 2 years, where the VC funds now all of a sudden they're in year 3 of their fund that they raised in the hype cycle. They're like looking at their books like, oh my goodness, everything I invested, I underwrote to a scenario where $1 billion was the baseline, and that's not reality. Like all the multiples have shrunk. And so that's why you see the VC funds, like the phase 1 was all the VCs just stopped giving term sheets. They were like, we want to like figure out what's going on. We're scared to make any new investments. Like, let's go fix the investments we already did and like try to mark them down, see if they can be sold off, like see what the actual value of our portfolio is. So that was phase 1. So that's why you saw a lot of term sheets get pulled. I think phase 2 was actually, first was like planning, then was actually executing, doing bridge rounds on the companies that are doing well, like figuring out M&A in the portfolio, planning out how they were going to raise their next fund, what's the story they're going to tell their investors because they made shitty investments over the past few years. And then phase 3 is where we are now, where I do actually think that a lot of people have kind of cleaned up their books, accepted defeat, and are now thinking about, okay, what do we fund from here on out? Now, then you have to like predict the macro looking forward and say, okay, we are seeing a recovery across all risk assets. It seems like interest rates are changing. And so we learned our lesson from, overfunding startups. So let's restart with a more healthy makeup. And the challenge with that is the class of founders that started their companies in 2021, or even I would say like from 2019 onwards, that were used to having an idea and just kind of getting free money, they are so accustomed to that it's very difficult for them to be metrics driven all of a sudden. And it's really not their fault. Like if you are 24 and or 27, you've been in the startup space for the past 5 years since you graduated college, you have been taught that it's grow, grow, grow at all costs, like keep telling a story, keep raising more money, figure out monetization later. It's a very weird rug pull for all of a sudden your VCs to be like, oh, well, we expect you to be profitable, have millions of dollars in revenue by the time you raise your Series A, where just a year ago you weren't saying that. And so I think some of the shock is, yes, people are pulling back, but I do feel there's definitely enough money being raised by VC funds. I think the standard has just gone higher, or it feels higher, but I don't actually think the standards are that much higher. They were just a little bit out of control before. And so it's more of just a wake-up call of founders being like, wait, we actually have to build a business. We actually have to make money. Like, I thought it was free. And there is a batch of folks.
They're like, what the fuck is this?
Yeah, they're like, we have to build a business. I think on Twitter, what? And so I think that's the harder wake-up call. And so there are tons of founders that this is actually their time to shine because they've always been profitable. They've always known how to make money. They just didn't want to play the hype game. And it's their time to shine for sure right now. And they just had a leg up. And all the folks that had a hard time raising that didn't get the free money of the ZERP era are going to be really successful right now because they're not feeling this. I mean, they've always had to operate that way. And so honestly, women, people of color, all the folks that are underfunded are crushing it right now. If you look at some of the biggest successes, it's been the things that nobody's wanted to fund. Like Black-owned beauty brands are popping off, and nobody wanted to fund those. They're like, we hate CPG, it's so rough. They're making hundreds of millions of dollars. Like, it's just funny the categories that are doing well. It's like the most, they used to call it like uninvestable categories are all doing well.
I want to hear more about Spice Capital. Given the picture you just painted, what are you looking at and excited about right now?
Yeah, there's two things you have to do when you run your own fund. When you're pitching investors, I realize they're not actually visionary. Like the people that are investing in me, right? They're paying me to have some vision of the future or some imagination of what the future could look like. So you actually have to pitch them what's hot today, because they're reading Wall Street Journal, seeing a headline, and then emailing me and being like, did you invest in this category? And so,
that sounds
like,
terrible.
So annoying.
That sounds so annoying.
Yeah, which is super annoying. And like what they don't know is if I'm investing in it today, like I've already missed the boat. Like that
Totally.
was late. If it's like OpenAI in the headlines, like sorry. Anyways, but that's like the psychology that drives that's why we have public markets. Like it is that human psychology which drives all of it. But yeah, and so I think outwardly I'm pitching myself as like, we're in, you have to throw in the buzzwords. Like if you look on my website, I have AI and creator economy and blockchain. But what I really try to think about is what are the next batch of categories? Like what are things that are not considered buzzwords right now that will be buzzwords one day? And so that's kind of the whole ethos of Spice Capital. It's like go find domain experts, subject matter experts who really know their industry well, who have a vision of what the category could look like. I would fund those types of founders all day over, hey, I just dropped out of Stanford, like I'm really smart and I want $5 million to go figure out a new idea and I'm really good at shipping. I don't think that model works. For me, that's not the archetype I like to work with. So our focus and the categories we're excited about are really the categories that I would say there's no market map around yet today. And so I'll give some examples. Like one theme that I'm exploring right now is the new wave of religion. And so everyone in the West, in my opinion, we're not as religious. We might have been raised religious, but we've all become quite individualistic. And as a result, what happens, you see people gravitating towards buzzwords like community, and you see people doing forms of like what I would call religion, but they're characterized as health and wellness. So like meditation, even like the bathhouses, like even that's a subculture that really is just about people coming together. Yoga, and you kind of saw wave one of it was yoga and meditation, and wave two is we're getting more and more esoteric. Like there was a study that 1 in 4 Americans believe in mysticism, and so all of a sudden now you see like astrology, tarot, you see a lot of, I'm sure like I have a lot of friends that now see psychics. I'm like, wait, what? When did this happen? But it's not so different than going to your priest and then being like, God will figure it out. Like God has a plan. It's very similar. It's like you're looking for guidance. And so we invested in like a tarot card marketplace company 3 years ago, which feels insane 3 years ago. But now looking at the kind of the landscape in a post-pandemic world, people are craving that sense. Like they're just craving answers. They feel lost. There's like this spiritual nature that it's replacing a spiritual void. And so we try
do you watch Industry?
I don't, because I'm triggered.
Yeah, of course.
It reminds me of like my
early days.
Yeah. So
well, there's this one scene that you don't remind me of this person at all. He's a horrible person and a terrible character. But he goes on an ayahuasca trip, and at the end of his trip, he like turns to the guy that he dragged along with him. And he was like, "We got to figure out a way to monetize this." And I was like, "It's like
that's
a little
me.
bit."
That's literally me. So yeah, I go to Times Square and I'm like, "What can I monetize?"
I love it. No, but I totally see that trend, and like it kind of even falls into like the run club stuff and like all of this sort of like pickleball obsession. Like people are looking, and I even went to a talk this weekend that was about tech, and everybody was like, "What was your read on the talk?" And I was like, wow, this talk reminded me so much of church. Like there's a real like, even in like the tech community here in New York, there's sort of this experience of the industry that feels almost like religious to people, where it's like their deep belief system and sense of belonging and purpose is coming from the industry that they work in. And I think it sort of speaks to what you're talking to as well.
Totally. And like we now are on our phones all the time. We're drawn into our work. Our identity. I mean, everyone's anti-institution, anti-establishment, but then they're like saying that, but then they're buying into a different institution. Like
Yeah.
the crypto people are buying into a different philosophy, and that's another branded institution, like all around Bitcoin, or degrees of layers and degrees away from Bitcoin as like your god, which is horrifying. But
Scary.
so we
Dark.
try to do, I know. So we try to do things like that. So I mean, there's a why for every category I've listed on my website. Like the creator economy, again, like that's the buzzword people can understand. The average Joe investor can understand. But what I'm really seeing there is, okay, there's a new batch of people. You guys are a great example, and a lot of our friends where they are literally, I mean, I think of creator economy as the new small business. And so it's folks that are making 4, 5, 6, 7 figures online as a side hustle, sometimes as their main career in something that they're just passionate about, something they know. And I would think that a lot of us, if we were our age 30 years ago, 40 years ago, we might be creating a small business, a brick and mortar concept. And now we're just doing a digital version of that. So it's like a digital small business. So think of how big like the SMB industry is, $1 trillion industry. I'm sure everyone saw OnlyFans is doing like whatever, $8 billion a year in revenue, making at the same scale as some of these AI companies, which is insane, and more actually. And what happens to all that income? Like when all of a sudden somebody is doing something out of passion and they have an internet business and it's generating a lot of money, how do you professionalize them? So when I think of creator economy, it's like, how do you professionalize this new class of income coming in? Is it now, you have a new batch of folks that they don't have finance degrees. And so they don't have, a banker. They don't understand how to optimize their taxes. They don't understand all these small things. They don't understand expense management. Like, how do you simplify all of that so the person can do what they're really good at? That's how I think about creator economy. And then within applied AI, I mean, that's just a way of saying application layer. I think that when there's a big bias around, or it's easier for VCs to invest in infrastructure, that's the easiest thing to do because I mean, you see it in crypto, right? It's like, yeah, let's build more infra. Let's build more infra. It's an easy place to park money because your bet is, hey, I don't care what actually gets built on it. It's like oil. I'm going to get a cut of everything so long as the industry grows. It like requires more taste to pick an application and say, hey, this team is really good at building product. This team really understands a specific problem that will use the technology to then solve a specific subset or a specific set of problems for a group, and that group will continue to grow. So application layer investing is much harder. I enjoy doing that because I think every time there's a new platform shift, like, when blockchain came to market, now with all the AI stuff, there's an opportunity for like 100x better user experience. And it's usually folks that come from industry or have some sort of customer insight that end up building it. And it's usually the folks that don't get funded quite easily from other investors. And so I thought it was pretty funny when OpenAI came out, like the immediate reaction of all the investors was first to go fund clones of ChatGPT. So that was like the first thing, like, let's go raise as much money as possible and park it into other LLMs, which going back to the beginning, why would you do that if you're a VC fund? It's because you can raise $4 billion to invest in these like massive rounds and you get paid the management fee on it. So like that was phase one. And then you would see blog posts coming out right after like, any ChatGPT wrapper is a scam. Like ChatGPT wrappers are uninvestable. That was the narrative. And I was like, okay, just the fact that people were saying that, I'm like, I want to go look at ChatGPT wrappers. And then when you look at ChatGPT wrappers, my insight was, holy shit, this is amazing because you can essentially build an application layer and your underlying tech keeps getting better. Like you have free R&D. Mm-hmm. In what world do you have free R&D? Like your costs are the same. If anything, the models are getting commoditized. So the prices are getting cheaper. And so you can build a front end and have the best back end that keeps getting more and more efficient and cheaper and better. That's amazing. That's a technology person's dream. And I was like, it's so funny that everyone is not funding it. And I had to really think about like, why is that? And then I thought more about the financial incentive. And so we made a kind of like a stamp of, hey, we're actually going to fund application layer businesses where nobody else wants to. And then sure enough, like 12 months later, a year later, I see blog posts that are like, LLM clones are dead, application layers where you should be investing. And so a lot of what we do at Spice is like to be really good at early stage, I not only have to believe in a founder early, I also have to time the category zeitgeist and like the category zeitgeist with the investors, because likely if something is not hot amongst other investors, the price is better. Like my entry price is better. I have no competition on most of the deals I'm doing. Like nobody else wants to invest. I can convince them all day. I don't have to worry. It's more about like really supporting the founders and being that first believer. And then what you want is over time for the category to be known. Like you want people to know what application layer means in AI and people to be like, oh, I know what that means. Or you want it to become a buzzword. You want creator economy to become a buzzword over time. Like that's when I am slowly exiting the position. Yeah.
Wow, Maya, if I gotta say, if I had any money to deploy, I would put it right in Spice Capital.
Agreed, wholeheartedly.
Oh my God.
Thank you so much for coming. This was so great. I feel like I could talk to you for literally hours about this.
Totally,
and,
totally incredible.
Yeah, thank you so much for your time.
Thank you for having me. I think I went a little bit off the rails. I'm very passionate. No one ever asked me about these things, and I feel like I've had to learn it all from zero. Like I didn't really know much going into it. And so it's really fun to share these things because I think people don't know. And if you follow the money, you'll always have a better sense of how any industry works. Like the game of any industry, you just follow the money.
Wow. I learned so much. Thank you so much, Maya.
Thank you for having me.